On June 3, 2026, the Department of Finance in Ottawa released an official statement that at first glance appeared to be almost entirely routine, yet carried profound geopolitical weight. Finance Minister François-Philippe Champagne announced that Canada would maintain its comprehensive steel and aluminum tariff measures, keeping them firmly in place for another full year. This announcement was delivered without the theatre of a dramatic speech, an angry press conference, or any performative pounding on a podium. Instead, Ottawa issued a restrained, calculated message centred on the long-term objective of creating a Canadian economy that is fundamentally stronger, more independent, and better insulated against future external macroeconomic shocks. Beneath this calm diplomatic and bureaucratic language, however, laid a highly strategic decision. It was a tactical move that would rapidly reverberate through corporate boardrooms in Cleveland, Charlotte, and Pittsburgh, while simultaneously triggering immediate adjustments in the equity prices of three of the United States' largest domestic steel producers. This specific action marks a critical turning point in an ongoing economic conflict, illustrating how a mid-sized economy to the north, which policymakers in Washington had spent nearly 2 years treating as mere collateral damage in its broader trade battles, quietly managed to reverse the pressure on the very domestic industry Donald Trump had promised to insulate and protect. To fully understand why this specific regulatory moment carries such extraordinary structural weight, the timeline must be traced back to the opening months of 2025. It was at this start of 2025 that the Trump administration revived Section 232 tariffs on imported steel and aluminum, aggressively raising the existing rate from 25% to 50%. The underlying political argument presented to the public was simple and easy to understand. American steelmakers required strict domestic protection from lower-priced foreign metal, targeting imports from Canada, a nation that had spent decades operating as a deeply integrated and trusted partner under North American trade agreements. Initially, Wall Street enthusiastically welcomed the aggressive protectionist shift. When the Trump administration formally announced in the middle of 2025 that the tariff rate would be doubled to 50%, shares of Cleveland-Cliffs, Steel Dynamics, and Nucor all climbed sharply the following Monday. Cleveland-Cliffs alone experienced a massive surge of 27% in pre-market trading. Institutional investors and market analysts operating under the assumption that they were looking at a highly protected, captive domestic market, which would inevitably yield wider profit margins and leave domestic industrial consumers with significantly fewer import alternatives. For several months, this market assumption appeared to be entirely correct, but protectionist trade policies invariably carry a structural cost. And Wall Street began paying that economic price much sooner than anyone had originally anticipated. The critical miscalculation in Washington's strategic playbook was the assumption that Canada would remain entirely passive. Ottawa did not react in the predictable manner that American trade planners had forecasted. The Canadian government did not simply accept the punitive tariffs, passively watch its domestic market share disappear, and quietly move on. Instead, Ottawa began fundamentally reshaping its entire international trade strategy to counter the American pressure. By late December 2025, the Canadian government enacted a powerful retaliatory countermeasure, imposing a 25% tariff on roughly $10 billion Canadian dollars worth of steel derivative products. These targeted measures covered an exceptionally wide range of industrial and consumer goods, including doors, windows, wire, fasteners, structural bridges, and wind towers. Simultaneously, Canada sharply restricted access to its own market by reducing tariff rate quotas for steel arriving from countries without a standing free trade agreement. Those specific import quotas were drastically cut from 50% of 2024 import levels down to a mere 20%, while any shipments arriving above that strict limit were hit with a punishing 50% surtax. While Ottawa carefully preserved its critical CUSMA exemption for the United States and Mexico, it simultaneously tightened regulatory access for nearly every other source of foreign steel attempting to enter the Canadian market. In highly practical terms, Canada was systematically reserving its domestic steel demand for its own domestic producers and its compliant CUSMA partners, establishing a parallel defensive structure under its own sovereign rules. by June 2026. Ottawa reinforced this exact economic strategy by extending these precise defensive measures for another year, sending an unambiguous signal to global markets and Washington that it had absolutely no intention of backing down first in this high-stakes economic chess match. This is the exact juncture where the narrative becomes deeply uncomfortable for the American steel executives who had spent the majority of 2025 celebrating the implementation of American tariff protection. Cleveland-Cliffs, led by its famously aggressive chief executive Lourenco Gonzalez, had made a massive strategic gamble in 2024 when it completed the purchase of the major Canadian steel producer Stelco. At the time of the acquisition, the corporate reasoning appeared entirely solid. Cleveland-Cliffs intended to combine its domestic production capacity with one of Canada's premier steel assets, thereby benefiting from growing industrial demand across the entire continent. Gonzalez frequently described this vision to investors as building a fortress North America, a highly integrated, closed steel network fully protected from Asian and European competitors. Instead of operating as a crown jewel, however, the Canadian acquisition transformed into a severe financial burden almost immediately. Stelco's cross-border sales were badly damaged by the 50% American tariff placed on all steel shipped from Canada into the United States. The structural irony of the situation was impossible to miss. A trade policy explicitly designed by Washington to defend American steelmakers was now directly undermining and hurting the Canadian subsidiary of one of those very same American corporations. This unexpected corporate entrapment forced Lourenco Gonzalez into a striking tactical shift, where he eventually began publicly calling on the Canadian government to build stronger tariff walls of its own. In effect, the chief executive of a major American steel company was openly asking Ottawa to defend the Canadian mill he had just purchased, utilizing the exact same kind of protectionist mechanisms that Washington was applying against foreign competitors. This represented the ultimate strategic trap of the trade war. Cleveland-Cliffs had aggressively bought a Canadian producer because management expected to completely dominate the lucrative steel corridor running between Canada and the United States. Then, sudden shifts in American tariff policy transformed that exact northern asset into a growing, capital-draining liability. Meanwhile, Canada's retaliatory system was successfully redirecting internal steel demand back toward its own domestic producers and compliant CUSMA partners, but it was doing so strictly under Ottawa's rules rather than Washington's oversight. The financial consequences of this structural shift became undeniably apparent when Cleveland-Cliffs released its first quarter financial results for 2026, showcasing the deeper damage this geopolitical friction was causing. Full-year corporate revenue for 2025 had already fallen by approximately 3% to $18.6 billion, a decline that had previously forced Gonzalez to candidly inform investors that any financial improvement would arrive gradually, quarter by quarter. While the chief executive pointed to high energy costs and delayed pricing structures as the primary operational obstacles, the underlying reality stripped of corporate language was clear. The company's major Canadian acquisition was actively losing money, and the broader protectionist landscape had fundamentally fractured the continental market. The financial markets did not wait around for corporate management to correct its course or prove that the continental strategy could be salvaged. Throughout the first half of 2026, nearly every new signal, leak, or official statement emerging from Washington regarding tariff adjustments caused American steel stocks to undergo sharp, volatile swings. More and more frequently, the trajectory of those market swings was heading firmly downward as the broader economic realities of the trade friction began to manifest. A clear demonstration of this market vulnerability occurred in February 2026, when media reports surfaced indicating that the Trump administration was privately considering a reduction in steel and aluminum tariffs in a strategic bid to ease mounting pressure on consumer prices ahead of the upcoming midterm elections. The reaction on Wall Street was instantaneous and severe. In a single trading session, shares of Nucor, Cleveland-Cliffs, and Alcoa plummeted, with major steel and aluminum entities experiencing intraday losses between 5% and 6%. Institutional investors had begun rapidly pricing in the potential return of foreign competition and the subsequent disappearance of the artificial pricing advantage that domestic producers had enjoyed for over a year. For Cleveland-Cliffs, this market turbulence followed an even harder financial blow suffered only days prior. The corporation had severely missed its fourth quarter revenue forecasts by nearly $300 million. Shortly after this disclosure, the company's chief executive executed a massive sale of 3 million corporate shares, netting more than $37 million. This sequence of negative financial indicators spooked the market, pushing the stock down by almost 17% in a single chaotic trading session. None of this corporate and market volatility was occurring in isolation. It was unfolding precisely while the Canadian government moved decisively beyond simple tit-for-tat retaliation, embarking instead on the construction of a parallel steel economy that relied less and less on American industrial production. This represents the specific dimension of the trans-border trade dispute that the vast majority of mainstream American business coverage has completely ignored. The dominant narrative broadcast within the United States has consistently been one of unilateral, one-sided leverage. Washington imposes punitive tariffs, Canada absorbs the economic hit, and the narrative concludes. However, the hard economic data reveals a far more complex and highly interdependent reality. Steel import volumes into the United States fell by 12.2% over the course of 2025, and this contraction continued unabated into the opening months of 2026. While at first glance this trend appears to represent a definitive victory for domestic American steel producers, lower import volumes quickly created secondary structural crises throughout the domestic supply chain. American manufacturers that depend fundamentally on steel, most notably automotive manufacturers, large-scale construction firms, and appliance producers, were left paying significantly higher prices for a smaller, restricted, and far more expensive pool of domestic supply. Canadian producers, conversely, having been shut out of seamless access to the massive American market, adapted by operating behind their own government's tightened quota walls against non-CUSMA foreign suppliers. As a direct result, Canadian mills began aggressively redirecting their production capacity toward fulfilling domestic Canadian demand, servicing European customers via developing alternative trade agreements, and securing CUSMA-compliant business that completely avoids the harshest of the American tariff exposures. Canada did not lose this economic confrontation by remaining passive. It systematically rebuilt its trade relationships around the tariff walls, leaving American industrial consumers and certain producers to absorb the unintended collateral damage of a policy originally designed to shield them. The precise timing of these macroeconomic developments matters just as much as the specific regulatory policies themselves, because timing is the primary force driving the next stage of this economic conflict. On April 2, 2026, the Trump administration escalated the trade friction by issuing another formal Section 232 presidential proclamation. This specific executive action expanded tariff coverage to copper for the very first time, adding it to the existing restrictions on steel and aluminum, while fundamentally changing the methodology used to calculate import duties. Under this newly implemented method, the majority of industrial derivative products were taxed based upon their full finished commercial value rather than merely the intrinsic value of the raw metal they contained. For Canadian industrial exporters, this administrative shift effectively eliminated a key legal loophole that had previously offered substantial financial relief. Certain Canadian manufacturing entities had previously chosen not to claim CUSMA preferential treatment because avoiding that designation allowed them to receive a significantly more favorable tariff calculation based strictly on raw metal weight. Once the full value rule took legal effect, that specific cross-border corporate strategy became entirely useless. For a vast array of automotive components and advanced downstream derivative products, CUSMA compliance no longer provided any meaningful tariff advantage or protection from American duties. Then, on June 1, 2026, a mere 2 days before Ottawa announced its own long-term extension, the Trump administration signed another major trade proclamation. This measure temporarily reduced tariffs from 25% down to 15% on a strictly limited group of industrial products, specifically focusing on agricultural equipment and residential heating and cooling systems. Simultaneously, however, the proclamation severely strengthened legal and financial penalties for importers accused of falsely reporting domestic American content in an attempt to circumvent the broader tariff architecture. Crucially, these tariff reductions were explicitly designated as temporary, scheduled by law to expire at the absolute end of 2027. This built-in expiration deadline exposed the deep instability and unpredictability that had come to define the entire North American trade structure. Commercial businesses operating on both sides of the border were being forced to make long-term, multi-million-dollar capital investment and supply chain decisions under a volatile tariff regime that seemed to shift or undergo modification every 6 to 8 weeks. All of this mounting tension and regulatory chaos was taking place just before the single most important structural checkpoint in the history of the modern Canada-United States trade relationship, the formal Joint Comprehensive Review of the Canada-United States-Mexico Agreement, which was scheduled to officially commence on July 1, 2026, the very day after this recording. This scheduled joint review was not a routine administrative checkpoint or a mere bureaucratic formality. The built-in CUSMA review clause gives all three American governments the legal opportunity to completely reconsider the agreement, extend its lifespan, renegotiate specific terms, or allow key trade provisions to expire entirely. Canada had spent the period from September through November 2025 holding exhaustive public consultations specifically to solidify and prepare its strategic position. Ottawa systematically gathered feedback from domestic corporations, trade lawyers, and industrial groups regarding which parts of the Continental Agreement were functioning efficiently, where structural friction remained, and where Canada needed to resist American diplomatic and economic pressure most aggressively. The Canadian government had already clearly indicated that it would enter this review process with a much firmer, less compromising position than it took during the original USMCA negotiations under Donald Trump's first presidential administration. Officials in Ottawa had spent most of the previous year systematically creating the exact economic leverage they planned to bring into these pivotal discussions. A separate tariff architecture targeting non-CUSMA steel, stronger domestic and regional partner supply chains, and a domestic public that had watched its government refuse to retreat or concede for 18 straight months. The government handled this escalating trade dispute in a manner that was fundamentally different from the traditionally conciliatory approach Canadian leaders historically adopt when managing friction with Washington. Instead of rushing toward a hasty compromised agreement simply to alleviate immediate economic pain for exporters, Ottawa strategically utilized the crisis to accelerate a much broader structural economic shift. It deliberately expanded alternative international trade relationships, reinforced domestic industrial supply chains, and treated retaliatory tariffs not merely as a localized punishment, but as an active tool of sovereign industrial policy designed to permanently shift demand toward Canadian and CUSMA-compliant producers. The steel and aluminum tariff extension announced on June 3rd was explicitly not presented by Finance Minister Champagne as a defensive or reactive measure. Rather, he described it as a core component of building a stronger, more independent, and more resilient Canadian economy. That specific choice of words carries immense weight because it demonstrates that Ottawa no longer views this confrontation as a temporary storm. It simply needs to endure. Canada is treating the trade friction as a structural opportunity to permanently reduce its long-term economic reliance on the American market altogether. For the United States steel industry, this structural decoupling represents the real, long-term danger hidden inside what initially appeared to be a straightforward protectionist victory. Among the major American producers, Nucor has performed the best financially, with its stock rising about 16% since the beginning of 2026 and gaining roughly 41% over the previous 12 months. Much of that financial resilience stems directly from its domestic, scrap-based electric arc furnace operating model, which naturally limits the kind of heavy cross-border supply chain exposure that has severely hurt competitors like Cleveland-Cliffs. Even so, Nucor's own corporate guidance for the first quarter of 2026 pointed toward weaker overall earnings. The company explicitly stated that its steel mill division was expected to perform at roughly the same level as the fourth quarter of 2025, when earnings had already plunged 71% compared to the prior year, while its steel products division was projected to decline further, after dropping nearly 50% year-over-year in the previous quarter. Meanwhile, Steel Dynamics has managed to remain the most stable enterprise in the domestic peer group, continuing to offer a respectable dividend and maintaining a strong buy consensus among institutional analysts. Conversely, U.S. Steel remains the most symbolically important name in the entire domestic industry, and it has found itself trapped in what market analysts describe as persistent acquisition limbo. Its consensus investment rating continues to hover around a stagnant hold, with some financial forecasts projecting the stock could potentially fall another 14% from its current market levels. The common thread running through this entire industrial landscape is a continental tariff system that has become extraordinarily complicated, frequently adjusted, and deeply dependent on overlapping conflicting rules between Section 232, Section 122, and QSMEM preferential rules. Trade lawyers and international accounting firms are openly struggling to keep up with the regulatory shifts. Canadian tax advisors have spent a significant portion of 2026 issuing repeated emergency updates simply to track the rapid sequence of new presidential proclamations. The specific order in which these tariffs are legally applied, whether a company claims QSME treatment or pays the standard Section 232 rate, and whether an individual shipment qualifies for a narrow exemption listed in a specific regulatory annex, can alter the effective import duty by dozens of percentage points on the exact same industrial product. Following a key Supreme Court ruling on February 20, 2026, involving Presidential Tariff Authority, the Trump administration increasingly shifted toward utilizing Section 122 of the Trade Act of 1974. This specific provision allows the executive branch to impose temporary import surcharges, but those measures cannot remain in legal effect for more than 150 days unless Congress explicitly approves an extension. This inherent legal weakness means the volatile tariff structure supporting this entire geopolitical confrontation could be legally challenged, revised, or partially overturned in court before the comprehensive QSME review is even completed, introducing an acute layer of structural uncertainty for executives attempting to plan multi-year capital investments in either country. As the formal review begins, no trade lawyer, steel executive, or macroeconomic analyst at TD Economics or RBC Wealth Management has a completely reliable forecast for how this confrontation resolves. The review process is fundamentally structured to bring to the forefront the exact structural disputes that have been building since the beginning of 2025, making a smooth or predictable outcome highly unlikely. The United States enters the renegotiation table having secured some genuine domestic gains. Steel import volumes are down, domestic pricing has been artificially insulated for select producers like Nucor, and the core 50% tariff remains active. The Office of U.S. Trade Representative Jamieson Greer has publicly categorized the steel and aluminum tariffs as highly successful, even while conceding that technical modifications may be required to resolve mounting compliance and supply chain problems. Canada, however, enters the exact same review from an entirely transformed position of strength. It has successfully constructed an alternative regulatory framework that no longer depends entirely on American industrial demand, extended its own protective measures deep into the middle of 2027, and spent more than a year demonstrating to international markets and its own electorate that it will not accept unilateral American pressure without responding in kind. The steel industry sits directly at the epicenter of this geopolitical collision because steel was never merely another commodity. It has become the ultimate test case of whether tariff nationalism actually delivers its stated promises, or if it simply pushes the economic damage down the supply chain until someone else is forced to absorb the blow. July 1st does not mark the conclusion of this conflict, but rather the point where the confrontation moves into an entirely new, more intense phase as three sovereign governments sit down to determine the future rules governing $3.6 trillion in annual North American trade. For more deep dive geopolitical and economic analyses on global trade wars, ensure you are subscribed to this channel and hit the notification bell to stay updated on the latest developments.